Who doesn't absolutely love the idea of waking up, grabbing your phone, and seeing that a massive company like Coca-Cola has just deposited free money directly into your checking account? No extra work, no selling off your shares, the cash just magically shows up. I mean, it's the ultimate financial dream, right? But then you've got the other side of the aisle, those so-called boring investors. And they'll tell you, hey, stop overcomplicating things. Just buy the entire market, sit perfectly still, and wait 30 years. Well, today, we're going to settle the score. We're diving into exactly what the data tells us about these two heavyweight financial philosophies.
Okay, let's dive into this head-to-head matchup. In one corner, we've got the undeniable allure of passive income, literally getting paid just for owning a tiny slice of a business. And in the other corner, the ultra-patient, entirely hands-off approach. Buying the whole market and playing the ultimate long game. We are going to impartially weigh the whole shebang, the pros, the cons, the cold hard math, and, maybe most importantly, the deep psychological impacts of both of these camps. Here's our fight card for today's explainer. First up, we're decoding dividend investing. Second, we'll unpack the index fund strategy. Third, we're going to run them both through a realistic $50,000 retirement stress test. And finally, we'll deliver the final verdict. All right, let's meet our first contender. Section 1, Decoding Dividend Investing, the Mechanics and Psychology. So at its absolute core, dividend investing is simply about becoming a tiny owner in established, massive legacy companies. Thanks Johnson & Johnson or Procter & Gamble. You buy a piece and you get a cut of their profits in cold, hard cash. And this brilliantly illustrates the central metric that dividend investors care about most, the dividend yield. It's basically the measuring stick for this entire strategy. You just take the annual dividend paid out by the company and you divide it by whatever the stock is currently trading for. Let's ground this with a super concrete example to show just how simple the math really is. Say you're looking at a stock, right? And it's currently trading at exactly $100 a share. If that company pays out a $4 dividend over the course of the year, well, you're getting a straightforward 4% yield. You buy the stock for $100, you get $4 a year. It's really that simple. But here is where it gets highly optimized. You don't actually have to sit there analyzing individual stocks, sweating over picking the perfect companies. No way. You can utilize what's known as a distribution ETF. Basically, this is a single fund that holds a giant basket of dividend-paying companies. So you buy this one thing, and suddenly, you are getting dividends from dozens, sometimes hundreds of different corporations, and it's all just funneling regular income straight into your account. So why do people absolutely love this approach? Well, the advantages are incredibly compelling. First off, it generates income without forcing you to sell your actual shares. You get to keep your golden goose, but you still get to eat the eggs. Second, and honestly this is massive, is the psychological stability it provides. Just imagine, the market is crashing. Your portfolio value is tanking on paper, but that cash just keeps hitting your account every single quarter. That reassuring, highly visible cash flow, it completely helps prevent panic selling. Plus, strong companies historically grow their dividends over time, which acts as a fantastic built-in hedge against inflation. But hey, we've got to be ruthless here and look at the downsides, right? Because dividend investing is definitely not flawless. For one, these portfolios often get highly concentrated in slower growth sectors, think utilities or real estate, which means you might totally miss out on massive tech booms. Second, and this is absolutely crucial to understand, dividends are not free money. Actually, scratch that. It's more like it's a transfer of value. When a company pays a dividend, its stock price actually drops by roughly that exact same amount. You also face taxable friction, meaning getting taxed on those payouts slows down your long-term compounding. And finally, there is a massive trap here, chasing yields. When you see a company offering a dangerously high 7, 8, or 9% yield, that usually means the company is really struggling and the stock price is completely tanked. Huge red flag. Okay, that brings us to contender number 2. Section 2, the indexed fund strategy, buying the haystack. So this whole philosophy was really popularized back in the 1970s by Vanguard founder John Bogle. He essentially realized that trying to pick a winning stock was just a fool's errand. So he basically said, look, don't look for the needle, just buy the haystack. By definition, an index fund simply tracks a market index, like the S&P 500, which of course represents the 500 largest companies in the US. Instead of paying some professional fund manager a massive fee to guess which stocks are going to go up, this strategy just buys a tiny piece of the entire market. It's automated, it's highly objective, and it provides instant massive diversification. Now, what's really interesting about this slide is this incredibly tiny number, 0.03%. This represents the insanely low management fee you can get with some index funds today.
Now compare that to the typical 1% fee charged by active Wall Street fund managers. Over the span of, say, a 30-year investing timeline, avoiding that 1% fee can literally mean hundreds of thousands of dollars kept right in your pocket rather than handed over to a broker. It's wild.
The data-backed advantages of index funds are frankly incredibly hard to argue against. You get broad diversification, which practically eliminates the risk of a single company going bankrupt and completely wiping you out. We just talked about the beautifully low fees. They are also highly tax efficient because they don't trade frequently, meaning far fewer taxable events dragging you down. And historically, this boring strategy is a total powerhouse. The S&P 500 has historically averaged around an 8 to 9% annual return over long periods. It just compounds beautifully over decades. But this strategy does have a dark side, especially when it finally comes time to retire. It introduces a genuinely terrifying reality known as sequence of returns risk. Because an index fund doesn't automatically drop cash into your checking account like a dividend does, you literally have to sell off your shares to pay for your life. Sequence of returns risk is the danger that the market experiences a massive crash right in the first few years of your retirement. This forces you to sell your precious shares at rock-bottom prices, effectively locking in permanent losses. And that really outlines the hidden downsides of the index approach. You completely lack that comforting, automated income stream. Instead, you're forced to actively sell off pieces of your portfolio just to survive, which, let me tell you, feels completely unnatural during a market downturn. The strategy is scientifically sound, sure, but it is psychologically brutal. Doing nothing sounds super easy in theory, right? But when you're watching your life savings drop by 30% on a screen, and there's absolutely no dividend cash rolling in to reassure you, staying disciplined is incredibly, incredibly hard.
Let's move to and see how this builds into our next segment. Section 3, the ultimate test, the $50,000 retirement scenario.
Okay, so imagine you want to retire, and you figure you need $50,000 a year in income, just ignoring taxes for a second for simplicity. How much do you actually need to pull this off? Well, looking at the top-line comparison, the index fund path actually requires slightly less upfront capital, about $1.25 million, compared to the $1.4 million you'd need on the dividend path to hit that exact same $50K goal. Why? Well, that's because the index path relies on the widely studied 4% withdrawal rule, whereas the dividend path assumes a very realistic 3.5% yield. Now, the index fund will likely give you higher overall growth because you own the whole market. But look at the bottom line here. This is where the rubber really meets the road. During a market crash, the dividend investor is just sitting back, watching the cash continue to arrive. The index investor? They are being forced to log in, sell off their shares at a loss, and physically watch their nest egg shrink. Ouch.
All right, we've looked at the mechanics and the numbers. Time for Section 4, the final verdict, math versus psychology.
So, impartially, the ultimate winner here really depends on whether you're asking a calculator or a human being. On the math side, the cold, hard data definitively favors index funds. The numbers just prove it. Lower costs, broader diversification, and historically higher total returns. But on the human side, psychology heavily favors dividends. That automated, highly visible cash flow is basically a behavioral superpower. It flat out prevents people from making terrible, emotional decisions when the economy gets scary.
So the crucial point is perfectly captured in a quote from our source material. The biggest mistakes don't come from choosing one of these approaches over the other. They come from behavior. That hits the nail right on the head. Panic selling during a recession, chasing dangerous high yields, or being so paralyzed by trying to find the perfect strategy that you never even invest at all. Those behaviors will destroy your wealth infinitely faster than picking the wrong lane here.
Which leaves us with one final vital question you have to ask yourself. Because the scientifically perfect portfolio, it's completely useless if you abandon it the second things get tough. When the market inevitably drops, and trust me, it will, which of these strategies can your personal psychology actually withstand? Are you the type of person who can do absolutely nothing while your portfolio bleeds red, resting easy knowing you own the haystack? Or do you need the comforting reassurance of that cash dividend hitting your account to stay the course? Think about it and let that honest answer guide your path. Thanks so much for joining me on this explainer. Keep learning, and I'll see you next time.